A very good example in your database of questions, which actually explains how does a real life exchange of like kind business asset happen. Okay, please remember the term business use asset. The asset has to be a business use asset. It may be used for investment or it may be used for the purpose of carrying on a business, but it has to be a business use asset. Okay. So let's take an example. Okay. Let's say there was a farmer and this farmer had a field here. Okay. Let's say the field was 80 acres. This is a question that I had in a database. We'll do that question. And then there was a plot of land which was lying vacant, which is of 80 acres. And then there was another plot that this farmer had. Let's say his name is Farmer Joe. So this was also Farmer Joe's and this was also Farmer Joe's. Between, let's say, there was another person, Farmer F, who used to own another field. Now what this guy did was he went and he offered F that why don't you exchange your piece of land for my piece of land? Because if you do that, it becomes an exchange of like kind business assets, and this becomes my full property and this becomes your property. Is the purpose of this provision clear? Whenever we say there's an exchange of like kind business assets, we are typically trying to say that there is no deemed sale happening, guys. There is no fair market value. It's only cost rollover basis, right? Because we were, we got into this and the idea was not to generate profit out of this transaction, but just to facilitate certain situations. So we say ideal rule, please don't recognize any gate values. So it's a barter. It's a complete barter of a like kind asset, which is used in business reasons. I give you my land, you give me your land. So if that happens, we say it's an exchange of like kind business asset. And if it's a pure vanilla barter, nothing will happen. Let's say the value of this land in books of J was 100 million. And so what we'll do is we'll simply take F and we will put this 100 million. We'll just substitute and let's say this was plot 1, this was plot 2, this was plot 3. We'll just substitute plot 2 by plot 3. That's it. Nothing else. But what happens when I do not have a pure vanilla barter? Because in real life, we all want fair value exchange, right? So it might so happen that this property was a prime property and it was located at a very nice, intersection, and there was some nice boulevard or some stream here. And this has a higher value compared to a middle plot of land. Do you think just because of like kind exchange, Farmer Joe will just forget about the premium of his land? The answer is no. In that case, the other guy, which is F, might have to give him land plus cash, or he might have to also take some mortgage that Farmer Joe was holding in order to satisfy this like kind exchange. Now, the moment IRS says, see, I asked you to change hands without letting me know, and I would have forgotten about this entire incident. But when you did that, you did not do it plain vanilla. It was not plain vanilla barter. You had something intangible that flowed into your hand in form of cash. How can I ignore that? That amount you have to offer it to taxation. And that amount we called it boot. Okay? So in this example, Farmer Joe is receiving boot. Okay? And when you receive boot, it's something that you could not have hidden from the IRS. So this boot becomes taxable. Okay? Taxable in Farmer J's hands, in Farmer Joe's hands. Is the concept clear? General rule, if there is an exchange of like kind business assets, we are not going to offer anything for taxation. Problem, if there is something which was given in exchange, which was not only that asset. So what can be the possible things? You can give me fair value of something else, of some other asset. So when I did this, I did not have a lot of money. So what I did, I gave you my cash and I gave you my plot of land and I gave you my tractor. So I said, see, the tractor has a fair value of something. You take that tractor and I give you cash. Now this becomes boot for Farmer J, because this is something which is not plain vanilla. This is something that has to be offered to taxation. Okay. So our question is, General rule, if it's a plain vanilla barter, I would not have charged anything to tax. But if it is not plain vanilla barter, then what do we do? The answer is go step by step. Okay. Please, guys, whenever you see a question, if you want to understand the logic, I can explain that to you. But right now, what I want you to understand is I'm giving you steps, step 1, step 2, step 3, step 4, and I want you to follow those steps. Okay. Mechanically do every question in this area with those steps. If you're able to do it, you will get your answer straight away. Okay. So what is the first step? 1 second, guys. Give me 1 minute, guys. Okay. Yeah. So what you will do, the first step is calculate. So how do you calculate? What we are doing? We are doing exchange of like kind business assets. Okay. So what we are doing? We are going to do it stepwise. What is step 1? Step 1 is when you calculate the amount of money that you realized on the sale of the property. So basically, what is the amount realized? So when you calculate the amount realized, how do you do it? We say, okay, find out what is the fair market value of new property. I gave my land and I bought in your land. What was the fair market value of your land that I received? Okay. On that, you're going to add the fair market value of all the boot that I received, something which was not the property fair market value, something else, maybe some other property, maybe cash, maybe my debt that you have assumed, minus the fair market value of boot that I paid. This gives you amount which is realized. So if I tell you what is boot, okay, and if I draw a small chart and if I tell you, okay, what is this boot? You say, okay, I might call it boot received and boot paid. There might be some boot which is received. There might be some boot which is paid. What is boot? We say, okay, when it is cash, it is $1 that I'm receiving or it's $1 that I'm paying. Okay, so cash paid is boot paid, cash received is boot received. If it can be fair market value of non-like kind property. In my example, there's a tractor also that I'm ready to give you with that thing. Even in that case, if there's anything that I receive, it is boot received. If anything that I'm giving, it becomes boot paid. And the third thing is net relief from liability. If you are taking away my mortgage, then it is boot received from me. So this is handed over. I handed over my mortgage to you, it is relief to me, and it is boot received. But when I assume your liability, then the liability that I end up assuming, that becomes my boot paid. Is this clear? So this whole gives you the definition of what is boot. Okay. So first thing that you need to understand what is the gain which you have recognized on your income tax return. There's a difference between the word realized and recognized, guys. Realized is what happens in the real world. Recognized is how much of that has to be reported on your income tax return. Okay. So first step is find out how much is a boot received, how much is a boot paid. What is a receipt? If it is cash, non-like kind property, or when I'm handing over my liability to you, you are taking over my mortgage, that becomes my boot received. Boot paid, on the contrary, is when I am paying in cash, when I am giving you a property which is not plain vanilla barter kind exchange property, or if I am able to take your liability, that becomes boot paid. Then what do? You take the fair market value of the property that you're receiving, add all the boots received and minus all the boots paid. That gives you the amount that you are supposed to realize in the process. And once it is done, then you proceed to step. What is step 2? Step 2 is calculate the adjusted basis of the property. Okay? So calculate the adjusted basis or the net book value of the property. How do you calculate this? This is very easy. You calculate what is your original cost. This was the original cost of the property that I had minus my accumulated depreciation. So this gives me the adjusted basis or the net book value of the property that I have with me. Okay. So basically this is property given up, right? This is the amount that I'm realizing. This is the value of something that I'm giving up in my books. So what do? The balance, okay? Yeah. So that takes me to step 3. Now step 3 is easy, guys, right? Step 3 is calculate what is your gain, what is realized in the real world. Okay, so calculate your gain which you are realizing in the real world. How do you calculate it? You take your amount realized, okay, minus you take the adjusted basis of property. Please remember, guys, given up. Whenever you're calculating gain or a loss, you always do it with respect to the property that you're giving up, not with respect to the property that you're receiving in the process. Okay, so I calculated the amount realized. I calculated the adjusted basis of the property in my hands. I calculated what is my gain that I've realized in the real world. Then what do? Then you calculate the gain. So this is step 4 now. Okay, step 4. What is my step 4? Calculate the gain that you will actually recognize in your books. Remember, not realized, but recognized. How much gain is recognized in the real world? This is actually the lesser of what? 2 figures. Either the gain that you realized, that you calculated in the step above, or the boot that you have received, whichever is lower, guys. Okay, the lower of the 2 figures. Okay, please remember that realized losses are never recognized. We never recognized the losses on exchange of lifetime business property. Okay, so what do? Now you know what is the gain that you've made. Now you also know the gain that you have to report in your income statement. That brings us to finding out what is the gain that you have deferred. Okay, so calculate the gain or the loss that you have deferred. This is easy. What you will take it? This was my gain which I have realized minus the gain that I have recognized in my books by way of putting it in the income tax statement. This is the gain that I have ultimately deferred. That means I have excluded this gain from the tax net. Okay. Remember, this is the gain. If it is loss, then the total of loss is deferred. We never recognize any losses, guys. Okay. Why? Because loss is never recognized. Is that clear? Because losses are never recognized. Is it clear, guys? Then this is easy. This is the last step now. This is this last step, which is step 5. What do you have to calculate? You have to calculate the taxpayer's basis in the new assets, in the new property receipt. How do you do that? This is simple. You take fair value of the property that I have received. Okay. With this, I reduce all my deferred gain and I add back all my deferred losses. Guys, this is slightly different from the formula that your book has given, because in your book, they're adding and they're deducting the same thing again and again. So I've just simplified the formula. This is the basis of the new property. Okay. Let's take a question. Okay, is this clear? Let's do it step by step. Yes, bolo.
Ma'am, can I take the